Okay, let's dive right into this explainer. Today, we're putting Progress Software through what I like to call the ultimate financial gauntlet. We're going to take this company and rigorously analyze it using the legendary investment frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, and then top it all off with a strict discounted cash flow model. Our goal? Strip away all the market noise, look purely at the cold, hard numbers and the business model, and see if this stock can actually survive the stress test. So here's our agenda for this high-stakes obstacle course. We'll kick things off with a quick company snapshot, evaluate the stock through the lenses of Buffett, Lynch, and Graham, run our DCF and multiple valuations, and then wrap it all up with our final synthesis verdict.
All right, Section 1, Company Snapshot. Let's look at this acquire and optimize machine.
Now we are anchoring our entire analysis to the current stock price of $31.16, which gives the company a market cap of roughly $1.32 billion. Keep that $31 figure in the back of your mind, because every single valuation model we run today is going to be measured directly against that current price tag. The bull versus bear case on this one becomes pretty obvious right out of the gate. Progress Software doesn't really rely on hypergrowth. Instead, they run this fascinating acquire and optimize model. That basically means they buy up mature, sticky legacy software, things like OpenEdge and Chef, and they strip out the inefficiencies to absolutely maximize profits. And honestly, it works. It gives them an elite 82.3% gross margin. But here's the massive Achilles heel. They are heavily weighed down by $1.37 billion in debt compared to just $113 million in cash.
Moving on to Section 2, the Warren Buffett lens. Let's talk moats, management, and margin of safety.
You know, Buffett absolutely loves a wide economic moat, and Progress definitely has one. I mean, they have a 100% net retention rate. Why? Because migrating away from their legacy infrastructure is incredibly difficult for enterprise clients. The switching costs are just extreme. But then you hit the red flags. Buffett would absolutely despise their massive debt leverage. Add in the regulatory scrutiny from the recent MoveIt data breach and a noticeable track record of insider selling, and you start to see some serious cracks in the armor.
But let's look at the cash, right? Looking at approximate owner earnings, which, as we know, Buffett heavily favors over traditional accounting profits, the company pumps out a massive $230 million in trailing 12-month free cash flow. That represents an incredible 38.7% free cash flow margin, which just wildly outperforms most of its industry peers. So looking at our final Buffett checklist, the verdict is surprisingly clear. While the economic moat and those consistent, predictable cash flows easily pass his criteria, that suffocating debt completely disqualifies it for the Oracle of Omaha. A debt-to-equity ratio of 2.02 flat out fails his test for financial safety at this current price. Okay, Section 3, the Peter Lynch lens. Let's classify this growth story. Lynch famously categorized stocks into specific buckets to really understand how to value them. And with their sluggish organic sales growth hovering in the low single digits, we're talking usually between 2 and 4%, Progress Software firmly lands in this stalwart category. This is a slow, steady consolidator, definitely not some high-flying tech startup. Now, a stalwart needs a reasonable PE ratio. That's the price to earnings divided by the growth rate. But when you take its PE of roughly 16 and divide it by that minimal organic growth rate, it yields a highly unattractive number that sits well above Lynch's ideal 1.0 threshold. Simply put, you're paying a bit too much for very little organic growth. Ultimately, if Peter Lynch were looking at this today, he'd likely issue a definitive avoid or sell rating. The balance sheet is undeniably weak, C-suite insiders are actually net sellers through pre-scheduled trading plans, and the company just doesn't offer the rapid organic growth needed to offset those substantial risks. Let's pivot to Section 4, the Benjamin Graham lens. Time for the defensive investor's checklist. Running through his defensive investor checklist, Progress Software trips up pretty badly on liquidity. It boasts a current ratio of just 0.47. That means its short-term liabilities heavily outweigh its short-term assets. Combine that with the fact that they recently paused their dividend to protect their cash, and it completely fails Graham's strict safety standards. And honestly, the final nail in the coffin for a Graham investor is the intrinsic value calculation. When we plug the trailing adjusted EPS of $2.02 and the recent book value per share of $11.84 into Graham's legendary formula, the intrinsic value comes out to just $23.19. Compared to our starting price of $31.16, well, there is absolutely no margin of safety here for a quantitative value investor. Next up, Section 5. DCF and multiple valuations. Let's uncover the true intrinsic value.
Let's actually build the DCF model. We'll start with that massive $230 million free cash flow base. Then, we use a highly conservative 2% growth rate, which perfectly matches their mature market, and a 1% terminal rate. Factoring in a required rate of return, or WACC, between 8 and 10%, our DCF model generates a fair value range between $30.78 and $48.16 per share.
But you have to take a look at this sensitivity table, because this is crucial. Due to that massive debt burden we talked about, the equity value is violently sensitive to the discount rate. Even a tiny shift in your risk appetite, like just moving from an 8% to a 10% WACC, drastically pulls down the intrinsic value, all the way to the low 30s. The debt is essentially eating the first huge portion of the enterprise value. And when we cross-check this DCF math with alternative valuation models, specifically comparing their overall enterprise value to their core earnings, or EBITDA, against legacy peers, alongside an enterprise free cash flow yield model, well, both of these strongly suggest a fair value anchored squarely in the high 20s to low 30s. All right, Section 6, Synthesis and Final Verdict. Did Progress Software actually survive the gauntlet? So when we bring it all together, all these frameworks actually tell a surprisingly unified story. Whether we're looking at the DCF, the cash yield, the multiples, or the Graham formula, they overwhelmingly center right around that $31 mark, meaning at $31.16, Progress Software is perfectly, and I mean perfectly, fairly valued by the market today. It's neither a hidden gem, nor is it a value trap. The ultimate takeaway from this explainer really comes down to balancing a severe dichotomy. On one hand, the bull case is the undeniable superpower of its elite free cash flow and those incredibly sticky customers. But on the flip side, the bear case is the crushing gravitational pull of its highly leveraged balance sheet, especially when you realize they have $359 million in debt maturing very shortly. Blending all the insights from Buffett, Lynch, Graham, and our quantitative models, our definitive rating on Progress Software is a hold at current levels. The real opportunity for disciplined value investors just won't trigger until the price dips below $25. That's the entry point that would finally provide an adequate margin of safety against that massive debt. So I want to leave you with this final provocative thought to consider. In a higher interest rate environment, is a purely debt-funded acquire and optimize software strategy actually sustainable long-term, or is it just a house of cards waiting for the bill to come due? Keep a very close eye on their balance sheet over the next few quarters.